Hi, this video is the fourth video for Lecture 5. In this video, we will talk about corporate bond and credit spread of corporate bond. In previous videos of Lecture 5, we introduced how to calculate the market price of bond. This analytical framework applies to both the corporate bond and government bond. But we still have some small difference between corporate bond and government bond. Generally, we think yield maturity of corporate bond will be higher than the yield of treasury bill. Why? Because we have concerns about default in corporate bond. Corporate bond is issued by corporations. Corporations might be in financial distress or in a bankruptcy. When a corporation is in bankruptcy, it might default the coupon payment or the principal amount payment for the bond issued by this corporation. Because of this default risk in corporation, we have the difference between the treasury bill yield to maturity and the corporate bond yield. And we call this difference of yields as the credit spread or default premium. If the bond issuer won't default for the coupon payment or the principal amount, then we can calculate the cash flows promised by the bond issuer. However, if we have the situation that the bond issuer can default the payment, then we say we have the credit risk. Then the cash flows we expected to receive will be lower than the cash flow promised by the bond contract. So now we have an alternative way to think about the credit spread of corporate bond. The credit spread of corporate bond, or we say the difference between corporate bond yield and the treasury yield. It is driven by the difference between the promised cash flow and the cash flow expected to receive. Because we have these concerns of default risk, then we want to estimate the default risk of corporate bond. In fact, the default risk of corporate bond will be reflected in the market price of corporate bond. And we have a profession that collect information of corporation and provide the estimation for the default risk of corporate bond. We call them the bond rating agencies. We have many rating agencies in this industry. The two largest rating agencies are Moody's and Standard & Poor's. For a corporate bond, if it has a small probability of default, we say the default risk is low, then we say the bond is in investment grade. If the bond has medium level of default risk, we say it is speculative grade. So bond of speculative grade is riskier than bond of investment grade. If a corporate bond has relatively high levels of default risk, we say it is high yield bonds. So high yield bonds is more riskier than speculative grade. If a corporate bond has relatively high levels of default risk, we say it is junk bonds. Junk bonds is more riskier than high yield bonds. If a corporate bond is in default situation, then we say they are bonds in default. For these different groups of bonds, Moody's and Standard & Poor's use different systems of bond ratings, but the bond rating systems between the two large firms are very similar. So now let's have a detailed look at Moody's rating. Moody's use the ratings with large A for the bond of investment grade. They use the ratings with large B or large C plus double A for these speculative grade bond, high yield bond, and junk bonds. and they use the ratings with large C and one small a, or just simply C, for the bonds in default. Generally, we don't recommend investment for the bonds in default. In Lecture 4, we talked about the yield curves of Treasury bill. Similarly, we can draw the yield curve for corporate bond. A yield curve provides a yield of bond of different maturity. Here in this graph, the blue line provides the yield curve for the U.S. Treasury bill. The red line provides the yield curve of investment-grade corporate bond. We can see that at each maturity, the investment-grade bond, corporate bond, has higher yield compared with the Treasury bill. The green line is the yield curve of speculative grade bond. We can see that at each maturity, the yield of speculative grade bond is higher than the yield of investment grade bond. Why? Because the default risk of speculative grade bond is higher than the default risk of investment grade bond. Here, the black line is the yield curve of high yield bond. At each maturity, the yield of high yield bond is higher than the yield of the speculative grade bond, because the default risk of high yield bond is higher than the default risk of the speculative grade bond and the investment grade bond and the risk-free bond. Now I want to provide a brief summary for Lecture 5. In Lecture 5, we introduce the bond market, and we talk about how to calculate the market price of bond. Then we talk about how interest rate and coupon rate affect the bond valuation. In the end, we also introduce the corporate bond and the credit spread of corporate bond. Thanks.